Happy morning, people. So today in this session we'll be looking at May 2024 ka one consolidation question came, super duper question, right? So where parent company ka data they had given, subsidiary ka and associate ka. In fact, one question we had done it in a regular class, okay, where we had done subsidiary ka and associate ka common consolidation, okay. So it's a similar question with certain adjustment and certain controversial adjustment also is given. We'll discuss that, okay, sir. So they have given the three company ka balance sheet. So PP, they have given investments, they have given 14,000 shares in H, has 14,000 shares in S, they have 4,000 shares in A. So if you look at the next page, so S Limited ka total share capital is 2 lakh, in each share ka face value is 10, so they have 20,000 shares. A Limited ka share capital is 1 lakh and each share ka face value is 10, so they have 10,000 shares. So out of 20, H owns 14, so the shareholding percentage is 70%. And out of 5,000, out of 10,000, parent owns 4,000. So the shareholding percentage in A Limited is 40%. So S is our subsidiary company, A is our associate company, and this H Limited is the parent company over here. Okay. So these are all addition. Adding all these three, you'll get 12,10,000. Similarly, 4,80,000 plus 0 will give you 480. So basically, as investment subsidiary company S Limited, they don't have any investment. Associate also doesn't have investment. Adding these two, they've showed 250 over here. Okay, same way they have done this also. Current assets all they've added and they've made this total. These three addition will give you 785. Like that they have totaled. Okay, so that is fine. So we have retained earnings they've given. That's fine. So usual balance sheet, nothing much fancy. We have only one reserve. Following additional information is made available in respect of these companies. H Limited purchased shares in S on 1st October 2023. 1 second. This balance sheet is as on 31st March 2024. So shares have been purchased on 1st October 2023. Current year only we have got control, all right. But we have got the control not at the beginning of the year, but during the year. So because year starts on 1st April and we have got the control on 31st October. So keep this in mind, all right. So when the retained earnings of S Limited was 5 lakh, the day you got control only they have given 5 lakh. This 5 lakh rupees is not retained earnings ka opening balance. On the day you got control, they only given this 5 lakh is a balance. That means this is pre-acquisition retained earnings of subsidiary company. And shares in associate company we have acquired on 30th June, and on that day, on 30th June, retained earnings of associate company was 175. Again, this is also pre, right? Because even associate company makes any post-acquisition profit. Investment is valued under equity method, so investment in associate balance will increase. So for that we need, so both the companies ka pre-acquisition other equity data they have given in this particular adjustment. Great. Inventory of A Limited, associate company, as on 31st March 2024, include inventory valued at 60,000. which it had purchased from H. Who has the inventory? A Limited. A Limited is associate company. They have inventory. Why? Because they purchased the goods from H. That means H Limited, the parent, has sold goods to associate. So it's a downstream sale. Parent is selling the goods to associate. In fact, upstream, downstream, we refer it in consolidation of subsidiary chapter, but it's okay. We can use it here also. So parent has sold the goods to an associate company over here. All right, and we know this. So in A Limited inventory already includes this. Correct? No. I mean, sale has already happened. And has the parent company sold those goods at cost price? No. They've said here cost plus 20%. So parent company has sold this goods at profit. So this 60,000 rupees sale is already done. For associate company, it could be a cost price because selling price for one entity is cost price for another entity. From A Limited perspective, it is 60,000. But here there is a concept of unrealized profit. Since the goods have been sold at profit element, some profit is sold at profit, some profit element is included in inventory, which we need to eliminate. That only we call it as unrealized profit. So you always need to figure out in these sort of adjustment, this 60,000, no, from the seller perspective, because it is a seller. A Limited is a purchaser here. Purchaser will not make profit. So the seller makes the profit. From seller perspective, you have to analyze what is the 60,000. Sale is already completed. Now the other company, the purchaser is showing at 60,000. So since sale is already completed, the 60,000 is a selling price, right? So the profit is 20% on cost. So 60,000 is not the cost price, it is a selling price. So how do you get this unrealized profit, right? So 60,000 represents what? All this we know now. If cost is 100, profit will be 20% on cost, which will be 20. So selling price will be 120. So this particular 60,000, what they have given in the question represents selling price, meaning it is 120. We want profit element, which represents 20. So how much will be this? Proration. 16 to 120 divided by 2, or 16 to 20 by 120, which is 10,000 rupees. This is total profit. Okay, total profit included in inventory, but this is not subsidiary ka consolidation. If it is subsidiary ka consolidation, entire profit we will eliminate. This is a consolidation with respect to associate. Whenever we do consolidation for equity method, okay, whenever we do consolidation, associate company ka assets and liability we don't show. As far as parent and associate consolidation is concerned, parent will show in their consolidated financial statements investment in associate, and that too, this investment in associate is valued as per the equity method, right? So now, hence we only want our share. This is a total unrealized profit. Here we'll only take about parent share. What is the parent share? 40%. Shareholding percentage we already calculated here only, yeah. Parent has 40% stake in associate. So H limit, the parent share will be 10,000 ka 40% will be 4,000 rupees. Okay, since parent limited has made the profit here, the entry will be what? Associate company has this inventory. We cannot reduce this profit from inventory because we are not showing associate company ka assets and liability at all. Associate ka inventory, we don't show it in CFS. So hence what we have to do over here, if parent company has sold this goods at profit, means associate ka inventory includes profit. So associate company ka inventory includes profit, means inventory is an asset. Due to this profit element included in closing stock value has increased. If asset value increases, net asset value will increase. If net assets of associate company increases, means our investment we value based on net assets, because parent is a shareholder in associate. If the associate company ka net asset increases, means our investment also will unnecessarily increase. But this we only sold, no? Hence this is unrealized profit, which we need to eliminate. Yes, sir. So here what we have to do, due to this transaction, investment in associate balance we need to reduce. And since parent made this profit, this particular 4,000 should also be eliminated from parent ka retained earnings. So the entry will pass as retained earnings account debit to what? Investment in associate company. So this is the journal entry you need to pass in your consolidated financial statement to investment in associate. That associate company is A limited now for this. So in both the working notes, in retained earnings working note and investment in associate working note, you need to reduce by 4,000, which we will confirm it later on. Once we'll read off the adjustments. Now trade payable of H limited includes 25,000 payable to A limited. So H ka trade payable includes some amount payable to A limited. So mutual owing, sir. We need to eliminate, sir. No, sir. In consolidation, subsidiary ka all assets and liability we show. Hence, any mutual owings in the form of trade receivables, trade payables, yeah, loan given, loan taken, etc., we eliminate. So this H limited ka trade payable is in relation to an associate. Associate company ka assets and liability we show no. Hence, this is not a mutual owings to be eliminated. That may be mutual owings, but you cannot eliminate it because associate company ka assets and liability we don't show. So hence, this adjustment is irrelevant for our calculation perspective. Okay, so this is like, you can think that this is not even there. Suppose this was related to subsidiary company, means then what you're thinking is right, we need to reduce that. Goodwill in respect to acquisition of S limited, S is subsidiary, has been fully impaired. Whatever goodwill you got in the date of control, as per IND AS 103, they're saying it is fully impaired. Recoverable amount of investment in A limited, associate company, exceeds its carrying amount. They're saying recoverable amount exceeds carrying amount. So if carrying amount of investment is 100, means the recoverable amount exceeds. Maybe it is 120 or anything. So do we have any impairment loss here or no? Impairment loss will only come into picture if carrying amount is greater than recoverable amount. Okay. Here they're saying recoverable amount is greater than carrying amount. That means indirectly what are they trying to say here? Indirectly they're trying to say that investment in associate, there is an impairment loss concept on investment in associate also. They are saying investment in associate company ka value is not impaired. That's what they're trying to say. And NCA is valued at proportionate share of identified net assets. Basically, NCA is valued at PSNA basis. Okay, fine. That means the goodwill that you get is only parent share of goodwill. Okay, and that means NCA will not bear any impairment loss on goodwill. Here, as goodwill is fully impaired, no. So only parent will bear that impairment loss. NCA will not bear it because PSNA basis. 10% declared. 10% declared. We declared. In fact, it should be was declared by both H limited and S limited. The parent and subsidiary company, both of them have declared 10% dividend. A limited declared 15% dividend for the current year. So associate has declared 15%. All the three companies have declared the dividend. Parent and subsidiary to the extent of 10%. Associate company to the extent of 15%. On 31st March 2024, S made a bonus of 1 equity shares for every 2 shares held. Subsidiary company, they made bonus. What is subsidiary ka share capital? Subsidiary company ka share capital is 2 lakh. They made a bonus in 2:1 ratio. For 2, you'll get 1 as bonus. Total capital, share capital is 2 lakh. So bonus ka value given is 1 lakh rupees. Bonus in a way has no impact on this thing because due to bonus shares, you give bonus shares out of general reserve, retained earnings or whatever, right? So due to this, reserves and surplus will reduce, share capital will increase. So that means ultimately there will be no impact as such. Okay, unless you give it on pre-acquisition profit, which I'll tell you in one more problem what that is. Okay. So, but as such here, we don't have any problem over here. Okay, so it has no impact. Dividends were declared, but were not accounted by all these companies. So dividends are declared, but it is not accounted on them. Crazy. Why? We'll see. in the books before year end. Similarly, bonus issued by subsidiary company was not reflected in the balance sheet. So they're saying bonus is not reflected, it's not accounted. Fine, anyway, bonus has no impact that way because retained earnings will reduce, share capital will increase. So this has no impact. Now, dividend adjustment, no, sir, what they've given is a little controversial. Okay, what is that controversy? Sir, dividend, we know that it should be accounted when it is approved by the shareholders in AGM. Yes, no, when the dividend, in fact, that's what they've given over here. Okay, when the dividend gets approved by the shareholders in annual general meeting, that day you can go ahead and account to the dividend. Okay, so here when they say dividend declared, no, they have not told whether this dividend is declared by the board of directors or whether it is what is happening over here. Usually dividend will be declared by the directors, board of directors, then it will get approved by the shareholders in AGM. No, dividend is declared by board of directors, that is fine. But they use the word here, dividends were not accounted. So what can student assume? One student can assume that dividend is declared by the board of directors, but it is still not yet approved by AGM. That is one assumption you can make. Or second assumption you can make is dividend is declared by the board of directors and it is approved by the AGM but not yet paid. Okay, that assumption you can make. Or you can make a third assumption, dividend is declared by the board of directors, okay, and approved by the shareholders in AGM also, but paid off. So that means three possible assumptions we have. That's what they've called out over here. And for all the three, they have solved. Okay. So this was an examination question. Okay. For that too for 14 marks. Such a controversial adjustment straight away if you give it an examination without thinking. Imagine the students' kahalat. Okay. So first of all, associate, in fact, for us, associate is not a new concept. Okay. We have done. In fact, same question if you check in our notes, we have. Yeah, dividend adjustment and all may not be there. But overall, how to consolidate subsidiary and associate together, we have done that. So that is okay. But dividend adjustment, they should have given a little clarity. Okay. Whether it is declared and approved, not yet approved. Because here they're saying declared, here they're saying it is not accounted. So that means students will be confused. No, each student can make their own assumption and derive the answer. So hence they've given a clarification and solved all the three. Now for your reference, first one I'll solve, one you know, the other one if you know properly, other two you can do it easily. So this is actually a very simple question, except that this dividend adjustment, no, they had to bring in a little clarity. If they had brought a proper clarity on this was a very straightforward. In fact, it was almost, I would say, this is 90% similar to what we have done in our regular class. Okay, so let's go ahead with that solution, sir. So I'll show you all the three assumptions, don't have to worry. Okay, first alternative one is, okay, whether the first assumption is dividend is declared by whom? Board of directors, but not yet approved in AGM. That's the assumption we are making. So dividend is declared, but not yet approved. So we record the dividend only if it is approved by the shareholders in AGM. On the day dividend gets approved by in the AGM, that day we record the dividend. Till then we cannot record. So if this is the assumption if you are making, means dividend is dead to you. This particular dividend adjustment, no, we don't have to worry at all. So that means that is the easiest assumption. Make that. Okay, if it is controversial, because this way you don't have to do extra. I'll tell you the other two also, but hang on. Okay, sir. So we are making this assumption that dividend is declared by the board of directors, but it is not approved by the shareholders yet. Okay, it is shareholders approval is pending. So first, shareholding percentage we find put a working out, which you already know. Okay, in subsidiary company we have 70%, so NCI has 30%. Out of 20, parent had bought 14, so shareholding percentage 70 and NCI 30. In associate company, out of 10 we had bought 4, so shareholding percentage is 40. Okay. So that is one. Next, unrealized profit. We also calculated that. No, here. In fact, here we have something. So now, parent company has sold the goods to an associate company at what value? 60,000. So that means unrealized profit is 60,000 into 20 divided by 120. You want only parent ka share here, 10,000 ka 40%, which is 4,000. The same calculation I've showed it here in one liner. Okay, sir. That is one. Now your regular calculation. So for your consolidation, we put up some working notes. What is that? If there is any fair value adjustments, usually we prepare a working note for fair value adjustments, not there in this problem. Then shareholding percentage, if required, you can put it up here. Since we have multiple, maybe putting up shareholding percentage working note is a little better. I would suggest that. That is one. Then find out the normal consolidation working notes. Find out the net assets on the date of control. That is one. Once you know the net assets, you can calculate goodwill. And goodwill impairment loss is also very straightforward here because they said it is fully impaired. Then once you know the goodwill, find out post-acquisition profit. Analysis of post-acquisition profits of the subsidiary company and associate company. Because associate company ka post-acquisition share also you will get. Okay. So we'll prepare all these working notes parallelly for both subsidiary and associate. Then once that is done, you can prepare NCI working note relating only to the subsidiary company. That is one. Okay. Excuse me. So once that is done, then you can prepare the other equity working note, or here, in fact, since we have investment in associate, one more working note for investment in associate, and then your consolidated retained earnings, so you can call it as other equity. We don't have any other reserves here. I think so. That's the reason we have done that. Okay, sir. So these are your regular calculations. So let's start. So since there is no fair value adjustment, straight away working note is net assets on the date of control. Very, very straightforward. They've only told. So the day we acquired the shares, retained earnings of subsidiary company was 5 lakh. If you just check the balance sheet, only retained earnings is there, no other equity. Okay. So the retained earnings, the closing balance of subsidiary company is 7.5, but on the day you acquired control, it was 5 lakh. Okay. So how do you calculate net assets on the date of control? Share capital and all the other equity portion. So here retained earnings is 5 lakh. Take that. Okay, that's all. So first is share capital. What is share capital of subsidiary company? 2 lakh. So 1 minute here. Share capital is 2 lakh. Retained earnings on the date of control is 5 lakh. Bonus shares, as I told, has no impact because due to bonus, share capital will increase by 1 lakh. Retained earnings will reduce by 1 lakh. So I've just showed it and cut off here reference. It's fine. You can cut off. So net assets of subsidiary company on the date of control is 7 lakh. Adding these. Done. Same you do it for associates. Sir, why do we need to know that? Sir, associate company ka you get goodwill, right? Goodwill for subsidiary also you calculate, associate also you calculate, but goodwill relating to associate company, no, we only disclose, we don't account it separately. Goodwill relating to subsidiary company, we account it separately. Okay, we show it in balance sheet. But goodwill related to associate acquisition is only disclosed, but it is not accounted. But if you get capital reserve of associate company, it is accounted, which I'll tell you in a bit. So that's the reason all these working notes will do parallelly for subsidiary and associate. What is associate company ka net assets on the day you got control? The share capital was 1 lakh. This is retained earnings ka closing balance. On the day you got control, it was 175. Share capital was 1 and retained earnings was 175. So add these two, 1 and 175. It gives you net assets on the date of control to be, or not on the date of control, on the date of acquisition we'll call it. Because on associate we don't have control. We only have SI, significant influence, which is 2,75,000. Yes, sir. Yes. Then after this working note is done, we can calculate goodwill / capital reserve or bargain purchase gain. How do you calculate that? First take PC. First we'll do it for subsidiary. You need PC, then add NCA, then deduct fair value of net assets on the date of control. Right? So PC is given in the question here only. Investment we have. What is the investment value of parent? To buy subsidiary ka share, parent paid 560. Associate they paid 1 lakh. So 560 and 1 lakh. So here it is 560. Here it is 1 lakh. Okay, then NCA. NCA they told NCA is valued under PSNA basis. So NCA has how much percent stake? 30% stake. What is net assets of subsidiary company? Here be careful. Since you're doing it parallelly, don't pick the numbers relating to associate for subsidiary ka calculation. Okay. NCI will only be shown for S Limited, subsidiary company ka. Subsidiary company ka net asset is 7 lakh. NCI has 30% share. So it will be 2,10,000. Correct. NCI will not come for associate company. Yes. Alright. Then deduct fair value of net assets. We already got 7 and 2,75,000. Okay, 7 lakh here. Don't take 275 here. Or maybe I'll do that separately. So doing all this, you will get goodwill on the date of control of subsidiary company, which is 70,000. They told in the question goodwill is fully impaired. So impairment loss is 70,000. So goodwill ka closing balance is 0. Since NCI was valued under PSNA basis, this particular goodwill is a partial goodwill, meaning it's only parent share of goodwill and only parent will bear this impairment loss. That's what I've clearly told over here. NCI will not have any bearing towards this particular impairment loss of 70,000. So subsidiary ka calculation is done. Okay, then associate. As I told, associate company ka calculation you need to do it. Okay. Now, cost of investment is 1 lakh, which is given. Same calculation. NCI will not come, leave that. Now, can I take here? What do we take? Net assets. What is net asset of associate company? 275. Can I take entire 275? That will be wrong. Why? Sir, this cost of investment is only for 40%. Right? This cost of investment is only for 40%. So this 1,10,000 is this 2,75,000 is a net assets for whole associate company. A Limited associate company ka full net asset is 2,75,000. I mean this 2,75,000 is for 100%. So can you compare a 40% number with 100% number and say this is goodwill capital reserve? No. Since this is 40%, we should only take what? Parent's share of net assets. Because parent only owns 40% means they have 40% right over net assets. So take 2,75,000 into 40%, you will get 1,10,000. Now compare. The worth of the investment is 1,10,000, but parent company paid only 1 lakh. Okay, so or if you don't want in that way, do this calculation: positive number goodwill, negative number capital reserve. Or if you want logical explanation, net asset is a net worth of the investment. The worth of the investment is 110, but H Limited paid only 1 lakh, so they paid less. They paid less means if they pay more, it's a loss. We call it as goodwill. If we pay less means it's a bargain purchase gain or capital reserve. Here they're paying less, so it's a capital reserve. This needs to be accounted, which I'll tell you in a bit. Okay, Saru. So that's your calculation. This needs to be disclosed. Whether it is goodwill or capital reserve, show this calculation for associate company. Okay. Again, I'll say goodwill is not accounted because goodwill for associate company, we assume that it is included in the cost of investment. But however, if you get any capital reserve, that needs to be accounted separately. So this is one extra fitting in this particular question which we have learned. In the problem we had done in our class, no, we had got goodwill scenario. Okay, in fact, maybe I would have not shown that goodwill by mistake, I'm not sure. Okay, but whether it is goodwill or bargain capital reserve for associate company, you need to show. Goodwill we don't account separately, capital reserve we need to show it. So this is about goodwill calculation. Next is working note number 5, which is analysis of post-acquisition profit of the subsidiary company and associate. That is no adjustments, no, pretty straightforward, I think. So on the day you got control, okay, the associate company ka retained earnings was 5 lakh. At the end of the year, it has become 7.5 lakh. So that means 2,50,000 is post. Here, the day you got control, associate company had 175 balance and retained earnings. At the end of the year, it has become 424. So 424 minus 175, if you do, you will get post acquisition profit of subsidiary and associate respectively. Correct, sir? Yeah. Then, do you have any additional depreciation? No. Do you have any unrealized profit? No. Here, parent has sold goods to associate. If associate company had sold goods to profit, means we would have reduced unrealized profit from this working note. Yes. Here, parent is sold. So leave that. That means no adjustment, straight away whatever profit you have. Subsidiary ka profit will be distributed among parent and NCI in their ratio. Associate company ka NCI concept is not there. When associate company reports a profit, we know this, no? For associate company, we show the investment in associate in consolidated balance sheet. If associate company makes profit, then net assets will increase. Then that means investment in associate balance also will increase to the extent of our share, not total profit, right? So 2,49,000 is post acquisition profit. So parent company ka share is 40% of that, which will be 99,600. That's all is working on number 5 ka draw. Done, sir. Then NCI on the date of control. This NCI is only related to S Limited. So NCI on the date of control, do you have? Yeah, NCI on the date of control is 2,10,000. Then what, sir? Add post acquisition profit. What is their post acquisition share? 75,000. Then impairment loss. Sir, do we have impairment loss on goodwill here? Yes, but since NCI was valued under PSNA basis, okay, good impairment loss on goodwill will not come in. If it was fair value method, then I would have reduced impairment loss on goodwill also. But here we'll write nil because it is NCI is valued under PSNA basis. So NCI at the end of the year for consolidated balance sheet perspective is 2,85,000. Again, a very straightforward. Correct, sir? Then before we do other equity, let's do investment in associate company because we have associate also here, right? So investment in associate company, we do the accounting as per the equity method, right? So first thing, what is the investment in associate ka balance? Cost of investment, check the balance sheet. The cost of investment is, excuse me, it is 1 lakh rupees. Okay, start with that they have told. Then what's the simple? I had told one simple sentence for you. Initially investment is measured at cost of, then match investment in associate ka balance with associate ka performance. If associate company reports profit, investment in associate balance will increase. If associate company reports loss, then investment balance will reduce. If associate company declares dividend, then investment balance will reduce. All this logic I told in regular class. Now I'll not go into all that. Okay, all this we are solving in the last few days of exam. So I'll keep the things pretty short. Okay, does the associate company has reported any profit, post-acquisition profit? Yes. They have reported 249, but parent only will get their share, which is 99,600. Add that. Okay, sir. Then, do we have any impairment loss relating to investment? Impairment loss on goodwill was there. Impairment loss on investment is not there. So, ready. I mean, nothing is there over here. Okay. Then, has parent company sold goods to associate company? Yes. Was there any unrealized profit? Yes. What is the journal entry? The journal entry for this is what, sir? Due to this, we already wrote the entry. Retained earnings account, retained earnings of parent account debit to investment in associate. So due to this adjustment, investment balance will reduce. So minus 4,000 you have to do. So what about dividend? We have assumed that the dividend is not yet approved. So dividend adjustment will not come. If you just check, we have done almost all the question. Nowhere we have considered dividend because dividend is not yet approved. So if dividend is not approved, it will not come at all. The day it gets approved only, we start the accounting. Okay, sir. Then, do we have any capital reserve associated with associate? Yes, we have some capital reserve. How much is that? 10,000. We need to show the capital reserve. Okay. All right. Now, excuse me. Now, how do we show this? So, capital reserve is a reserve. So, right? Reserve has credit balance. So, the journal entry you need to pass over here is investment in associate. This is an associate company ka capital reserve. No? So, investment in associate, or that is A Limited account debit to capital reserve is the entry. So, due to this, capital reserve will increase by 10,000. Investment you are debiting means that will also increase by 10,000. So, add here by 10,000 because you are debiting investment. That's the reason. So, add up, you will get the value of the investment to be 2,05,600. That. Okay, G. Yeah. So, this is your working note number 7 for investment. Last working note for you is your consolidated retained earnings. That's pretty straightforward. Now, what is the retained earnings of the parent given in the question? The retained earnings of H Limited is 14 lakh. Start with that. Right? 14 lakh. Oh no, 14 lakhs actually the total. 5 lakh plus 9 lakh is 14 lakh total. So retained earnings of parent is only 9 lakh. So take that. Then post acquisition profit of subsidiary and associate both will be there. No, so post acquisition profit of subsidiary is 175, of associate is 99,600. So I add these two, it's done. Then impairment loss on two things, goodwill and investment. Goodwill it is there, yes. How much? 70,000. Entire amount impairment loss parent only will bear because NCA under PSNA basis. So goodwill ka impairment loss 70, investment ka impairment loss nothing. If it was there, it would have come, but here it is not there, so 0. Okay, sir. Then unrealized profit. Parent sold some goods to associate and made the profit. No, so the entry is retained earnings. Parent ka retained earnings account debit to investment. In investment, we already reduced this. Same 4,000 you have to reduce in retained earnings of parent also 4,000. Okay, sir. Then if you do this, you'll get the retained earnings for consolidated financial statement perspective. Is there any other reserve? Yeah, we have one more reserve called capital reserve, which I've added. So the total other equity is 11,10,600. That will come in your consolidated balance sheet. Very, very straightforward adjustment. Yes, no? So if you sort out the adjustment, means this is a very straightforward question. Okay, if the same question by chance comes in your attempt, make this assumption. Next to also I will tell you, those are little extra you need to do. This adjustment is very simple and very easy. So stick to this, stick to the easy fundas in examination. Now consolidated balance sheet, sir, that is very, very, very simple. Very, very straightforward. What is that, sir? Simple. Now H Limited ka and S Limited ka all assets and liability of that 100%. Associate company ka none of the assets, none. Associate company ka assets, liability, share capital, other equity, nothing will come. But relating to associate, only one component will come, that is investment in associate, which we already did working note number 7. That's all. Okay, sir. That means what, sir? Associate company ka all assets, liability, equity, other equity, you ignore. Only parent and subsidiary company assets and liability go on adding. So PP is 550 plus 480. That's all. Okay, that's what they've done over here. Check. Maybe I'll quickly bring that a little closer and show it to you here. Like this. Here PP 550 plus 480. This is relating to H. This is relating to S. Goodwill was 70,000. It's got fully impaired, so its value is 0. Okay. So basically, assets and liability of parent, investment in A Limited, associate company, which we have done a working note. Investment in associate as per our working note is 205,600. So that is what they have showed over here, 205,600. So inventory, no adjustment, no stock reserve, no mutual owings, nothing. So parent ka you take, subsidiary ka you add, associate ka don't add. Book value, all the data, H and S line by line you add. That's all. Associate company ka don't take. Investment in associate already showed over here. In equity, only share capital of subsidiary or parent will come. What is parent company ka share capital? 5 lakh. And retained earnings and other equity also we have already worked out. Total other equity is 11,10,600. That's what they must have shown, 11,10,600. Then NCI also will come from working note. Our working note says NCI is how much, sir? There is NCI here, 2,85,000. That's what they have shown, 2,85,000. Okay. Then other things and all. Again, H ka, S ka, straightforward, plain addition, balance sheet over. A very, very simple question, to be honest. Okay. Just that, because of that one controversial question adjustment, this whole question took a little drastic turn. But overall, otherwise, this is pretty straightforward. So this is the solution under first assumption. So make this assumption in your examination if same things comes. Then what if you make the second assumption? What will happen? I'll just quickly tell you the impact. Okay, don't apply this in exam. Okay, because you have to do extra. It will be unnecessary headache for you. But I've just solved it for your reference. So this is your alternate number 2. Let's take up and prove. 1 minute. Here actually, this should be alternate number 2. Actually, this is not 1. Alternate number 2, where first assumption was what did we do? Dividend was declared but not approved by the shareholders, not yet approved by the shareholders in AGM. We made the assumption. Here we're making another assumption where dividend is declared by board of directors. It has got approved in AGM also, but dividend is not yet paid, meaning it is outstanding. If this is the assumption, means what you have to do. So all the working notes now, in fact, all this I've just copy pasted. Okay. I'll show you one final impact. That final impact, you have to give it in 2 or 3 working notes and it is done. Okay. So what is that? Now, all the three companies have declared the dividend. If you just check over here, maybe I'll just show you the data once again for your reference. H and S Limited have declared a dividend of 10% and associate company have declared a dividend of 15%. Okay. So let's see the impact of this. H Limited ka share capital is 5 lakh. They have declared a dividend of 10%. So if you want to express the entry, we don't actually pass the entry directly. We reduce the dividend from other equity, but just for understanding purpose, I've expressed it in journal entry. So when you declare the dividend, retained earnings balance will reduce. So the entry will be retained earnings to dividend payable, because we have assumed that dividend is not yet paid. If it is not yet paid means dividend payable is a liability. Yes. So retained earnings to dividend payable is the entry H Limited has to pass. Now S Limited, same entry, but their share capital is 2 lakh and their dividend required is 10%. So they will write retained earnings account debit to dividend payable 20,000. Correct? Now, if subsidiary declares a dividend means holding company has the right to receive that. How much percentage share holding company owns? 70%. I mean, holding company also will pass the entry in their books. What is that? Because we know, we have studied also. Dividend is recognized as an income or revenue when the right, we have studied this, right? Dividend should be recognized as revenue when the right to receive the dividend gets established. That right to dividend gets established when other company declares it. Since subsidiary company has declared and approved it in AGM, a holding company will pass one entry. They have to receive this dividend. No, they have not yet received. So they will write dividend receivable account debit to retained earnings 14,000 rupees. That means what, sir? It's simple funda here. Retained earnings for consolidation perspective, we net off. No, so 20 debit, 14 credit. So effectively, net impact is what? 6,000. What is that 6,000? NCI share of dividend. Because if you do 20,000 ka 30%, NCI owns 30%. That will be how much? 6,000. So 20 debit, 14 credit is nothing but 6,000 debit. No. So basically, we don't have to do all this adjustment. Net impact because of this entry is what? Because if subsidiary company is giving dividend means holding company will receive it. So it's a mutual owing. It will get netted off. Only dividend relating to NCI we need to account here. So the entry will be what's that? Instead of writing dividend retained earnings to what dividend payable, you can write this is relating to NCI. No, so NCI account debit. Okay, 6,000 rupees to dividend payable. We have done this. No, pre-acquisition dividend should be reduced from the NCI working note we have studied, right? So that impact directly of giving. So since we have to reduce this from NCI, so we'll write NCI account debit to dividend payable 6,000. This is the final impact because of this particular entry. Okay, so this is for the S Limited. I hope you got it, right? Because 70% of the dividend which subsidiary is declared will be paid to parent. That will be netted off. For subsidiary, they will have to show it as dividend payable. The parent company will show it as dividend receivable. So all that will get netted off. So the dividend which is actually payable to NCI only is what we have to account. So effectively the entry will be NCI account debit to dividend payable. Even if you write retained earnings, that retained earnings has to be transferred. Okay, if you write instead of that NCI, if you write retained earnings also here. This retained earnings debit, if you do 6,000, that retained earnings is only pertaining to NCI because this is NCI share of dividend. So instead of writing retained earnings to dividend payable, directly you can write NCI, because if you write retained earnings to dividend payable, one more entry you have to pass is NCI account debit to retained earnings. Yes, because NCI share of retained earnings is reducing over here. That's the reason. Yes. So I directly pass the entry NCI to dividend payable. That's one. Okay, sir. This is for subsidiary. What about associate? Associate, same drama. Associate company ka anyway retained earnings and all we never show. But if associate declares dividend, then what will happen? If associate declares dividend means parent has to receive that. So dividend receivable account. And we already studied this. If associate company declares a dividend means their net assets balance will reduce. If their net asset balance reduces means the investment in associate balance also will reduce. So the entry here will be dividend receivable account debit. Okay, how much is that? Associate company has a share capital of 1 lakh. They have declared the dividend at the rate of 15%. So totally 15,000 is the dividend they have declared and got their approved. But parent has only 40% stake. So I multiplied by 40% if you do, it will be 6,000. So that means the entry the parent has to pass for this is dividend receivable account debit to investment in associate 6,000. So basically these three journal entry ka effect if you give it in consolidated financial statement, then it is done. So what is the impact here? Check. Here retained earnings is debited by 50,000. So that means if you debit retained earnings, its balance will reduce by 15,000. Then here dividend payable credit by 50,000, dividend payable credit by 6,000. That's all. So due to this, we have to create one additional liability called dividend payable called 56,000. So in your consolidated financial statement, dividend payable is a liability which will come for 56,000. That is one. Then dividend receivable will come in for 6,000 rupees. That is what we have done. Okay, sir. Then NCI you have debited. Sir, NCI you show it on the liability side. If you're confused about NCI ka balance, you show it on the liability side. So obviously it has credit balance. So if you debit it, NCI balance will reduce. So due to this adjustment, NCI balance will reduce by 6,000. Then investment and associate you have credited. Investment has debit balance. If you credit, its balance will reduce. So due to this. So this basically this 5 impacts you need to give it in consolidated financial statement. Like retained earnings ka, this is what you give it in other equity working note. You prepare, no? So if you just check here in working note number 8, I've reduced here by 50,000 rupees. That is a net impact I've called out. Wait, okay, this impact here. Done. Then dividend payable. Dividend payable is a liability. Dividend receivable is an asset. So in your consolidated balance sheet, if you just check, I'll show you consolidated balance sheet. Check here. Dividend receivable has come for 6,000 on the asset side. Dividend payable has come on the liability side 56,000. So that will directly come in balance sheet. That's what we have written over here. So these two, this will come as a liability in consolidated financial statement. This will come as an dividend receivable, will come as an asset in consolidated financial statement. Okay, sir. Investment in associate. For that we do a working note. Its balance has to be reduced by 6,000. So come back to investment in associate working note. So you have to write less dividend 6,000 rupees. That is our adjustment. Okay, sir. So this is also done. Next to NCI balance, you have debited, so its balance will reduce by 6,000. So come to NCI working note and check if it is reduced by 6,000. Where is NCI working note? Yeah, here dividend I've reduced by 6,000. So NCI balance has become 279. Previously, if you remember, it was 285. From 285, it has become 279. Check if you want in consolidated balance sheet. NCI balance is 279. Okay. And all this, if you incorporate, final retained other equity is 10,60,600. That is what here is shown over here also. Okay. Where is that here? 10,60,600. Okay. Basically, the impact. Do the same steps. So, okay. Okay. Copy paste. That's all. Okay. So these three entries ka effect, if you give it in CFS, that is done. That's all with respect to this adjustment. Okay, G. Next adjustment is also same thing. Okay, third alternative. Where is third alternative? I'll just show you 1 second. So third alternative is dividend is declared by the board of directors. It has got approved by the shareholders in EGM also, and it is paid also. In the previous problem, it was till here it was same assumption. In the alternative number 2, we assumed it is not yet paid. Here it is paid off. Okay, this is your alternative number 3. Okay, again the same impact. Sir, if dividend is already paid, then the entry will be what? The previously you wrote retained earnings account debit. Like parent company, you wrote H Limited retained earnings account debit to dividend payable. Here it's already paid means retained earnings to bank 50,000. Same amount. There you wrote NCI. For S Limited, the final impact you wrote it as NCI account debit 6,000. Correct? Excuse me. To dividend payable 6,000. So here what? NCI account debit to bank 6,000. Same entry. Instead of wherever dividend payable, dividend receivable is there, substitute with bank. That's all. There in alternative number 2 for associate company, you pass the entry dividend receivable account debit to investment in associate. Here you will write you already received it, no? Because we have assumed that we are assuming that it is already paid. So write bank account debit to investment in associate. That's all. So basically these three entries ka net effect you need to give it in consolidated financial statement here. What is the net effect? Retained earnings you debited by 50,000, so its balance will reduce by 50. Bank here you credited by 50, credited by 6, so 56. Here you debited by 6, so that means net impact is bank will reduce only by 50,000. That is one. Next to here you wrote 1 minute. These two are over. NCI you debited by 6,000, so NCI balance will reduce by 6. Investment in associate you reduce by 6, credited by 6, so its balance will reduce by 6. So this impact if you give, so here if you just check retained earnings have reduced by 50 over here. In retained earnings working note have reduced by 50. NCI working note we have reduced by 6,000. Investment in associate we have reduced by 6,000. Bank account we have to reduce by 50,000. That effect will be given in balance sheet. In current assets, if you just check, they have reduced over here 50,000. Okay, and that is the net impact. That's fine. Okay. That's all is this particular question all about. So first one is the easiest one. That's the alternative you assume. That makes the things a lot easier. But if you want to solve under alternative number 2 and 3, or in case ICA may modifies this question, gives more clarity and makes alternative number 2 as a proper question or alternative number 3 as a proper question, that also I have showed it to you for your reference. Hope this particular session was helpful to you. So all the very best. Take care. Bye bye.